what if I told you there's a force out there, one that's often called the eighth wonder of the world, that can quietly turn even modest savings into serious wealth? Now, it's not some kind of magic. It's a financial principle we're going to break down today, the incredible power of compounding.
So let me just start by asking you a question. What if your money could make its own money? And no, this isn't some fantasy scenario. It's the very real idea that your earnings could actually start generating their own earnings. And that, right there, is the core of everything we're about to explore. All right, so what is compounding, really? The best way to think about it is like a snowball rolling down a really big hill. It starts out small, but as it rolls, it picks up more and more snow, getting bigger and bigger and moving faster and faster. That's exactly what compounding does with your money. The returns you earn start to generate their own returns, and that growth just keeps accelerating. Okay, I know this might sound a little complicated, but believe me, there are some incredibly simple mental shortcuts that can help us wrap our heads around its power. So let's dive right into our first section, simple rules of growth.
First up, we've got a classic, a little trick that every investor should have in their back pocket, the rule of 72. It is a brilliantly simple way to get a quick estimate of how long it's going to take for your investment to double. And the best part, you don't even need a calculator.
Seriously, this is it. The only number you need to burn into your brain is 72. That's the whole secret. This one simple number is the key that unlocks this super powerful shortcut. So, let's see how it works. And using it couldn't be easier. You just take that magic number, 72, and you divide it by whatever your expected annual return is. So let's say your investment is growing at 9% a year. You just take 72, divide it by 9, and you get 8. That means it'll take you roughly 8 years to double your money. It's an awesome tool for a quick forecast.
Now this slide, this is where the real magic happens. It's all about the acceleration. This 8-4-3 rule kind of maps out a 15-year journey. Yeah, that first double, it might feel like it takes forever. Maybe those 8 years we just calculated. But look what happens next. The next double takes only 4 years, and the one after that, just 3. This is that snowball effect in action. The longer you let it roll, the faster and bigger it gets. Patience doesn't just pay off, it pays off exponentially.
Okay, so the theory sounds awesome, right? But how do we actually do it? How do we put this into practice? Let's move on to our next section and look at the modern tools, like ETFs, that help us harness all this growth.
Okay, this is a really important point. When we talk about investment funds like ETFs, we're not just talking about simple compound interest. The growth actually comes from two different engines working together. First, you've got capital gains. That's just a fancy way of saying the price of the shares you own goes up. And second, you have dividends. Think of that as your little slice of the profits that companies pay out, which you can then use to buy even more shares. And that's the compounding machine.
And just how important are those dividends? Well, get a load of this number. Over the last 50 years, a staggering 78% of the S&P 500's total return didn't come from share prices shooting through the roof. No, it came from just taking those small, regular dividend payments and plowing them right back in. That is the compounding machine running at full tilt.
All right, so what the heck is an ETF anyway? The easiest way to think about it is like a basket of groceries. Instead of buying just one apple or one orange, an ETF lets you buy the whole basket at once. And that basket holds tiny little pieces of hundreds, sometimes thousands, of different stocks or bonds. This gives you instant diversification, and you can buy and sell that whole basket just as easily as a single stock. So, how do these ETFs stack up against another popular choice, mutual funds? Well, this chart gives us a pretty good side-by-side. You can trade ETFs all day long, just like a stock. Mutual funds, only once at the end of the day. But here's the really crucial part for our compounding talk. ETFs usually have lower costs and are more tax efficient. And that just means more of your money stays in your pocket working for you.
And hey, don't just take my word for it. Listen to the man himself, Warren Buffett. His advice is so simple, but so profound. Costs really matter in investments. Every single dollar you pay in fees is a dollar that isn't compounding for your future. And that's why low-cost ETFs are such a powerful tool for anyone investing for the long haul. This brings us to maybe the most important ingredient in this whole recipe, time. So let's move into our third section, where we're going to explore the true and sometimes painful cost of waiting.
Okay, everyone, lean in for this one, because this slide is a total game changer. On the left, we have Investor A. They invest for just 10 years, but they start early. On the right, Investor B invests for 30 years. That's 3 times as long, but they start a decade later.
So, who do you think ends up with more money? It seems obvious, right? But believe it or not, in so many cases, it's investor A. The person who invested way less money actually wins. And the only difference? Their money had an extra 10 years to work its compounding magic. That is the unbelievable power of time.
So here's the bottom line, the biggest takeaway. Time is your greatest ally. It's literally the fuel for the compounding engine. Procrastination is the single biggest enemy of building wealth. Every single year you wait is a year of potential exponential growth that you can never, ever get back.
So time is your best friend, but there's a villain in our story too. Fees. Let's dive into our final section and see exactly how to protect that growing snowball from this silent threat.
I want you to think of high fees like a tiny, silent leak in a bucket. You know, one drop at a time doesn't seem like a big deal, but over decades, that bucket can end up half empty. Fees actually work like compounding in reverse, slowly but surely eating away at the value of your portfolio and stealing the gains that should have been yours.
And if you don't think a tiny little fee matters, look at this. This is what it does. We have two identical portfolios here. One has a tiny 0.1% annual fee. The other has a 0.5% fee. After 30 years, that tiny little 0.4% difference costs the investor over $1 million. $1 million! That's the power of compounding working against you. It's not just the fees you paid, it's all the growth that money would have generated for you.
Okay, let's put it all together. Here's your checklist, your simple game plan for making compounding work for you. Number 1, start as early as you possibly can. Time is your superpower. 2, reinvest everything. Keep feeding that snowball. 3, be consistent, don't panic, and try to time the market. And 4 and 5, keep your costs low and be tax smart. Don't let fees and taxes eat away at your future.
So there you have it. We've seen the theory, we've seen the tools, and we've seen the absolutely incredible potential. The snowball is sitting right there at the top of the hill. Your future wealth is just waiting to be built. So the only real question left is, what are you going to do to give it that first push? Thanks for joining this explainer.